welcome back to another episode of Financial Planning Tips with Wall Street Alliance Group. My name is Makiah Hunt, and I am a client service associate here. And today we have financial planner Keviin Shah, and he's here to talk about the difference between revocable and irrevocable trusts. So, Kevin, just to start us off, can you just tell us the difference between a revocable and an irrevocable trust?
Hey, Makiah, absolutely. I think the number one difference between an irrevocable and revocable trust is simply their purpose. So a revocable trust is ideal when you just want to avoid probate. So what is probate? When you pass away, there's a lengthy and costly process that happens if there is no trust, where the state comes in, they take control of your assets. Now, ideally, if you want to avoid this probate process altogether, a revocable trust is a great start. Irrevocable trusts are better suited for gifting purposes. So if you've got a high net worth and you need to get some assets out of your estate, then an irrevocable trust, such as a SLAT, these are great opportunities to get some money out of your estate so you avoid estate taxes.
Thank you, Kevin. So, can you just talk a little bit about the pros and the cons of the irrevocable trust?
Absolutely. So irrevocable trusts, I think, have two major pros. Number one, like we said, if your net worth is high, then any of the assets that you move out of your estate, any of the growth that happens on them, you don't pay any estate taxes on. So I think for those who have high net worths, right now the estate tax exemption is about $27 million. So in that range of around 15 to $20 million, this is a great pro for you. At the same time, anyone that's looking for some level of asset protection could look to an irrevocable trust. That being said, I don't think anything is perfect. There are some cons that come with it. I think the two major cons are, one, you do lose control over that asset. So like any good gift, Makiah, if I gift an asset to an irrevocable trust, I don't have real control over that asset anymore. So I better be sure that I'm ready to part ways with it from a control perspective. The second issue is what's called a step up in cost basis. So let's say, Makiah, that you and I bought a stock for $200 back in the day, 10, 15, 20 years ago. Now that stock has appreciated to $500. If we were to sell it today, we would pay some capital gains on that $300 gain that we experienced. At the same time, instead of us selling that stock, what if our heirs just inherited that stock? Then they actually get what's called a step up in cost basis, where they inherit it at the value of 500, or basically the value of whatever the stock is whenever we pass away. So they get a step up in cost basis. In the irrevocable trust, you do lose this. They would have to pay those taxes that we would have experienced as well. So I think this is another area where you better be sure that you've planned in terms of what you're gifting and you've taken into account these taxable implications.
So, Kevin, as a financial planner yourself, would you suggest setting up a revocable trust or an irrevocable trust?
Yeah, Makiah, great question. I think step one would be to create a revocable trust, just so that all the assets that you do have do avoid this probate. The second step then would be to think about an irrevocable trust when your net worth is close to that estate tax exemption. So like I said, right now in the US, the estate tax exemption is about 27 million. So in a net worth of about 15 to 20 million is when you can start thinking about it. Now, just to give you a high-level overview of what we spoke about today, a revocable trust is primarily used to avoid probate, whereas an irrevocable trust is primarily used for gifting purposes. That being said, an irrevocable trust has some pros and has some cons. Some of the pros are you do receive a level of asset protection, and most importantly, you are able to gift assets out of your estate, so you don't pay any estate taxes on them. Now, nothing is perfect, so some of the cons, like we said, are you do lose that step up in cost basis, and you lose some control over that asset. So be sure that you do the proper planning of which assets will be gifted and when. As a financial advisor, I believe that, we should go for simplicity in all of our different strategies, and estate planning is no different. Step one should be simply get the revocable trust done so you avoid probate for all of your assets. Step two is when you start thinking about irrevocable trust, when your net worth increases to the range of that estate tax exemption.
Thank you so much, Kevin, for this week's financial planning tips with Wall Street Alliance Group, and we will see you again next week. Thank you.